Well, hello again. I didn't have an opportunity before, but I'd like to thank Antonio very much for inviting me. It's a pleasure to escape Spain after pretty well a year, and I know you couldn't arrange the weather for me, but delighted to be here and see you all. It's now a privilege to introduce the next session. Various people have suggested how I call these three gentlemen, ranging from Terrible Trio to the Three Musketeers, or the Tremendous Trio, but to me they are three very serious professionals, and however much I'm sure they compete in their let's say public lives as respective heads of the real estate consultants as they form part of, what delights me is that they can come together and do a coordinated presentation. I've seen them do it before. This is going to be obviously an update and slightly more challenging times to talk about where we're going. But it's a delight to me to introduce Eric van Leuven of Cushman & Wakefield, Paulo Silva of Savills, and Francisco Ortega Costa of CBRE. There's a debate whether it's the eldest or the youngest who's going to speak for longest. You can decide on that when we get to the end. But at the end of this session, there is no recorded questions, so don't be afraid of the lectern. You can all ask and fire questions and debate what these gentlemen say at the end. Thank you. Eric, I think you're taking the stand first, yeah?
Thank you, and good morning, everyone. Carlos Moedas is a very hard act to follow, but we can bring it back to the more mundane level of our market, the dynamics of the market, etc. It's a pleasure to do this again. We did do this for the first time last year together. I had the privilege of starting off, and I have today because I'm the less youngest of the three. The title, The Eye of the Storm, was not chosen because of Barbara, but because of COVID. Barbara was actually a very unfortunate circumstance today. Fortunately, we're not in Editorial and we don't depend on good weather to have a drink outside. As last year, we put this presentation together, three of us. So let's say the ideas here represent our collective thoughts and views on the market. We will talk about the current situation, i.e. 2020 year to date. Then Paolo will talk about what's next, and Francisco about the winners and losers in the near future. So in terms of the current status of the market, we started off the year exceptionally well. The first quarter of this year broke all records, highest take-up, most investment, and in our respective businesses were going extremely well. We were all looking forward to 2020, which would be even better than 19 and 18. And then, of course, in Q2, the pandemic reached us, or at the end of Q1. And that did cause an abrupt halt to most things, not all things. But most things, and particularly it was very difficult to get decisions out of companies, and it was very difficult to make decisions for longer-term future circumstances. So Q2 was a slow quarter in most sectors of the market, and I'll talk about these more detail a bit later on. Q3, I think we were hoping for a quicker recovery, weren't we all? Weren't we all saying in May, well, in September we'll be back and start life as normal? I remember talking to our head of research for Greater China, who's actually based in Wuhan. He's a Scottish guy, and I spoke to him 2 days after Wuhan had reopened in April, I guess, late April, maybe early May. And he was telling me about things being not normal, but people going back into shops, into restaurants, of course, with masks and with a lot of contact tracing, etc. But it seemed like it was sort of a start to new normality. And so me and I guess many of us thought, well, okay, it took 2 months in China, we're back into back towards some degree of normality. That, of course, is not proving quite to be the case. So the pace of recovery is slower than we had anticipated. As a general comment, in terms of market values, headline rents are still stable. I mean, you won't see major decreases in rents, although there are more concessions. Obviously, landlords are fighting harder to retain or attract tenants. And yields are softening a little bit, but it's still relatively modest. And again, I'll come back to this. So, in terms of the office market, again, as you can see from the graph on the right-hand side, the 2020, of course, is year to date. So we've got 3 quarters of office take-up there, and as you can see, the first quarter, the dark blue line, is almost the same as 19, 18, and 17. So a very good start of the year. Second quarter, obviously a lot less, and then third quarter, year to date, less still. Today, or as at September, end of September, the total take-up is just about 100,000 square meters of offices. Very much driven by a couple of large deals. There's at least 2 of over 10,000 square meters, which is large for our market. Generally speaking, there is obviously a slower pace, less take-up. We're down by about 30% vis-à-vis 2019. It hasn't done a lot to vacancy rates yet, because as I guess most people know, vacancy rates are traditionally low in Portugal. As you can see from the graph, it's about 4% last year and this year, and maybe 5% or just over 5% in 2018. So in the last few years, vacancy rate come down because there was little new stock being produced and a healthy demand from all sorts of companies. The pipeline is relatively shallow. There's about 220,000 square meters under construction at the moment, of which some of it is already pre-committed. 200,000 square meters is a year of an average, or let's say of the last few years is the average of total take-up. So if we are producing 1 year of take-up over the next 3 years, because construction, as we all know, is a long game, there is certainly not the prospect of oversupply or increasing vacancy rates dramatically. Paolo and Francisco will talk more about, let's say, the future of the offices market and how obviously working from home, etc., has an effect on that, but I'll leave that to them. The retail market, of course, is one of the worst hit. Here, there's a clear, a much more pronounced reduction in demand. Contrary to the previous slide, where the data come from LPI, the Lisbon Prime Index, which is another great initiative of Antonio Gil, and which is an index, most of you will know, which has been going for more than 20 years, where all agents, property owners, property funds, etc., contribute. So it's a very transparent market with a lot of data. The retail market is less transparent. Customer Wakefield, we have our own database of deals based on valuations, all the shopping centers, most high streets, etc. So it's not the whole market, I admit, but it's certainly the same market we track for the last 5 years. And as you can see, in 2020, we've only seen about a third of the demand or the take-up this year so far. Most of which in the high streets, about 75% of this take-up of these new leases are in the high street as opposed to shopping centers, and about 64% is food and beverage. So that's obviously mostly in the beginning of the year. Still a lot of restaurants taking space. The retailers, of course, in most of them in real difficulty. Fashion is down by about 60% in terms of sales year to date. But there are some winners. Well, needless to say, pharmacies are up by 45%, according to Redonic, which is the credit card processor. But also neighborhood supermarkets, mini markets, etc., by 36%. That's an interesting phenomenon. So people obviously, went for shopping, certainly in the more confined periods, more shopping closer to home. There are other sectors are doing very well. Electronics up by 6%, white goods and brown goods, etc. Did I do something wrong? Sports are up. But generally, of course, retailers are finding it very difficult. Most shops were closed for 2.5 months. They're now reopened since June generally, but still finding it tough to find the customers and the spending, the will to spend from customers. In terms of rents, of course, the retailers were helped by the moratorium, which was declared for the first few months. And then with this very controversial law which is of the end of July, determining that from then onwards the retailers in shopping centers would only pay turnover rent as opposed to fixed rent, which is an incredibly unfair, blanket, blind measure. Which anyway, lots have been said, lots have been written, lots been discussed. We've tried to play our part as the ACAI, as the Association of Property Agents and Consultants, to try and influence the matter, but that was to no avail. Let's hope that this measure is not going to be prolonged in time. Industrial and logistics is, of course, one of the winners again of this situation. Very good interest, quite a lot of new space being built. We're talking to a lot of food retailers and logistics operators, very keen to set up new logistics parks in Portugal. With obviously the growth of e-commerce has increased the demand for logistics. It's interesting, and it's I think a theme for this period is that same thing that Carlos said. What COVID has done is accelerated certain trends, and I think of course, e-commerce was a trend which was already in place, but it's clearly accelerated during this period. We've been saying as a firm and probably as a sector, we've been saying for 3 or 4 years that the logistics sector was likely to benefit from the increase in e-commerce, which in theory, of course, is correct, but we're only seeing real evidence of it now. A number of real major things on the way. I mean, Lidl is building its new facilities for 48,000 square meters. Aldi 80,000 square meters. Then of course the developers, Merlin, who are not in the room, I don't think, but Merlin has now started building its the first unit of its 225,000 square meter Castanheiro do Ribatejo project. What's it called? Lisbon North. And so there is clearly a lot of activity in this sector. The hospitality sector, of course, is one that's even worse hit by the pandemic. This really is very dramatic, as you can see from the graph on the left. The occupancy rate is down to 25% year to date, and it was close to 70% in previous years. RevPAR, the revenues per available room, down to 20 euros. It was over 50. So hospitality very clearly badly hit. Also in real estate terms, not much activity in terms of buying and selling of units in the hospitality sector, with one exception, which was of course a pre-COVID deal where the Real chain was bought by local players for just over 300 million. So that was a major transaction and not very fortunate in terms of timing. Short stay accommodation, alojamento local, also a major victim and also almost a double victim because in addition to the reduced occupancy rates as a result of much less tourism, they were also, and this is something which predates COVID, hit fiscally and by the attempt, particularly in the major cities, to reduce the number of units which are allocated to short stays. The residential market is less impacted. It's still quite strong. Okay, it's not because this goes blank, but apparently it doesn't there. Still quite strong. Average sales prices, according to Confidencial Imobiliário, so that's obviously the truth and the whole truth, 6,000 euros per square meter in Lisbon and 3,500 in Porto. The rental market catching up. Obviously, more people looking looking to rent. There's also a couple of both local and central government initiatives to promote the rental market. And interestingly, it's probably the sector that most investors are now looking at or asking us about. PRS, private rented sector, is one of the most popular classes of asset classes that investors are looking at. Student housing is another area which is affected. There's a lot of new supply. Fortunately, there's some very good supplies and a lot of real professional players now active in the Portuguese market. Clearly, the initiative has gone from the public sector to the private sector. Generally, there's more demand, although of course this particular start of the academic year has seen less demand because there's been less foreign students. Rents are, again, headline rents are stable. We do know that there are concessions and discounts being offered in order to attract those students. And finally, of course, the capital markets arena, where most of us in the room are active. A slowdown, yes, a very good first quarter, as you can see on the dark blue bar on the right. 1.5 billion euros of transactions in the first quarter, very much driven by two large transactions, one for 800 million, which was the Sierra Prime, the sale of 50% of the Sierra Prime portfolio, which is the Sonai/APG-owned assets, Colombo, Vasta Gama, Cascais, North Shopping, plus 2 in Spain. That fund was established again in February. Very fortunate timing for the vendors. And then there was also this hotel transaction which I mentioned. So that makes up a large part of the 1.5 billion that you see on the graph. Of course, very little activity in the second quarter, and then a reasonable level of activity in the third quarter. But overall, we've transacted about 2.3 billion. The market has transacted about 2.3 billion year to date, which is actually more than this time last year. But the outlook for the year end is less than last year. We're probably looking at about 2.7, 2.8 billion euros compared to 3.3 in 2019. So a lot of processes which were going to be launched in March, April, May, which have been paused, and some of them are now being activated, and some are not yet. So I'm sure we'll see quite a lot of activity in the coming months and also in 2021. But there is clearly a flight to safety, as Carlos also mentioned in another context. More core players, more core assets being sought. In terms of what has done to prime yields, not an awful lot yet. You see the descending line from 2015 to 2019. Of course, a lot of interest, a lot of transactions, all asset classes, all types of investors. Real pressure on yields, with the lowest yields at about 4% for high streets and prime offices. We now see that there is a slight uptick in yields, not by an awful lot, 10 basis points to 35 basis points in prime shopping centers. That is, of course, an area of more concern and less demand at the moment. So that's a picture of where we are today, and I'm now, that was the easy bit of this presentation. I'm now going to pass to my dear friend Paulo for what's next.
Many thanks, Eric. Well, what's next? It's not easy to answer this, but before that I would like to place you a question. Which one of you, I would like to invite you to go back in time 1 year. Let's go to October 2019. Which one of you would imagine that 1 year later we all be here using masks? Okay, great. Francisco will speak about this kind of people, this kind of profile, this kind of vision. I share the same vision with you. I was far away, so I will have no pressure in trying to identify what's going to happen next. In what's going to happen next, what seemed to us scientific fiction is now a reality. We were far away from this new reality that is the driving force behind all changes. In fact, let me go to this way. it's complicated. So what's going to happen now? In 2020, we are being told that the offices are going to be finished. In 2002, they said that it was the end of skyscrapers. So as the skyscrapers didn't finish, we strongly believe that the offices are not on the way to finish due to the existing circumstances. So what is the question? The question is, at what extent can Zoom and Microsoft Teams replace the interaction with your teams? Can replace the emotion, the team building that is created when are all together drinking a cup of tea, when they are all together going to the water dispenser of your offices. This is something that it cannot be replaced. In Portugal, in 2019, 6.5% of people were working from home. This was above the European average. In 2020, in accordance with INE, 23.1%, approx 1 million persons, were working at home. This is a major difference that is going to impact the way that people are going to see the offices and the way that we need to manage this reality. The trend is that the flexible work will be very important. We cannot oblige people to return to the offices after giving them the experience that staying at home, they can do the same that they were doing in the offices. Something needs to change. So what some drivers of the change must take in account that 54% of the workers were satisfied with working from home. Nevertheless, 37% are satisfied with their work-life balance, almost 1/3 of the persons. 59% would like to work from home only partial time. And partial time is 1 or 2 days, not more than this, per week. So companies, real estate developers, the owners of the buildings may take in account this new reality, which is a reality on demand for office space will grow. And why it will grow? Because we need to keep more distance between people. When in the recent past we were used to have 8 to 12 square meters for each person, we are going to have a need in the nearest future to have 16 to 20 square meters per person. So to have the same number of people in the offices, this requires more space for offices to accommodate our staff. This is very important for us to take in account. The employee experience, as I mentioned to you, it's quite difficult. Our company, the first step that we have made in order to return to the offices was inviting each one of the departments to have at least one person staying in the office. Well, after 1 or 2 weeks, they were questioning themselves, what am I doing here if I can do this from home? So what have we done? We brought another person for them to teamwork. And this made completely the difference. So steply, we need to change this reality. And this is the challenge for the companies. Those companies that want to recruit and to keep the best talents, they must take in account that the office space each time more will make a difference. And in here, it's quite important to take in account one thing. We are not talking about a new reality. When we are talking about this reality that has to do with the quality of the spaces, this was a concern of the companies that was just leveraged with the situation of the COVID virus. Following the example of the e-commerce, e-commerce is not new. E-commerce was leveraged by the COVID situation. The last mile, this concept is not new, is being leveraged by this concept. So it's very important for us to what is the challenge that we are facing in real estate. We are being forced to provide answers more quickly to trends that were on the way to happen very slowly, and they are becoming more fast. And as we know, we have a difficulty regarding the offer of our products to accommodate this difference in a short period of time. The real estate use is no longer driven by cost. It will be driven by the staff preference, the staff concerns on the safety, on his health. It has to do with the productivity as well. And we have a new level of engagement between the companies, the employers, and the employees, and the new level of engagement between the tenants and the landlords as well. On retail, as Eric mentioned, one of the hardest hits. What happened to retail? Well, the e-commerce, as I mentioned, that was a trend on the market, significantly increased the activity. So what we assisted was on online shopping, an increase on the activity between more 40 to more 60%. On beauty and cosmetics, more 28% of the commerce in the internet. On medical products, more 19%. On furniture, more 39%. On the average expense in every transaction, an increase in 18%, from 34 euros to 40 euros. Nevertheless, it's quite important to take in account that only 37% of the Portuguese population is doing acquisitions through e-commerce, which compares with 60% in average of the European average. So we have a huge space to grow. And it's quite important that the growth on e-commerce will change the requirements from retail and from logistics, because from a certain moment on, there is a significant connection between these two segments of the real estate market. What is the survival guide for retail? Well, on physical stores, there must be a difference. The physical stores, they are going to have more uses than they had in the past. They are becoming showrooms. They are becoming places where you can pick the goods. So it's quite important that the trends that will assist the changes in the stores, they need to take into account this new trend. The omni-channel strategies. Well, this is no longer e-commerce or shops, physical shops. It has to do a mix. Please take into account what happened with one of the major operators in the e-commerce, which is Amazon. Amazon started, as we all know, by selling books through the internet. Nowadays, they sell almost everything, and they have also physical shops. So it's not a question of extremes, one way or on the other. We need to take into account the omni-channel strategies. Another important issue that we've seen with the offices is sharing the pains and the gains. We have seen with retailers, firstly, they stopped paying the rents. They started to change the contracts that they have signed concerning the length, the conditions, and they want to have a rent that is supported only by variable rent. This is something that we must take into account in this business as well. So COVID-19, alongside with e-commerce, they accelerate all this process. And for real estate, we need to take into account that first, there is a growth on interest in prime assets. And what are the prime assets? Prime assets are those that are located to ensure the greater proximity to the intended markets. Here it is the last mile working. Second, new technologies such as robotization will be a game changer as well in our industry, namely in logistics. The lack of available spaces to install last-mile distribution platforms is a reality, and we cannot suddenly make appear logistics space in the center of the towns. That's where everyone wants to be. And finally, nearshoring, that it was mentioned by Carlos Moedas. The companies are trying to put their offer very close to the markets on which they are operating. And in here, we are talking about another thing that we didn't mention yet. This has to do with sustainability as well. Because it's from a company point of view, I need to take into account that I cannot be producing my goods on the other part of the world, taking into account the concerns that there is with the aviation, the pollution, and so on. We need to be closer to our markets. Once again, this has not to do only with COVID. This was a trend, it was a concern that is being leveraged within this context. On logistics, the big opportunity. Everyone wants to make logistics, everyone wants to buy logistics nowadays. It's quite important that to take into account that the real estate strategies are central to this issue on the omni-channel. And as operators, consultants, developers, we must take into account this new reality to position us properly in terms of the winners that we can collect developing these concepts. On new logistics trends, to underline the last mile centers, the dark kitchens, the dark mall, and finally the big box storage. These are concepts that we'll start to hear very often from now on. Hospitality, which are the new challenges? What we have seen after 9/11 impact and 2009 global financial crisis was sharp declines assisted by a growth in process that took approximately 6 years. And this is our belief that this is what's going to happen in the new times. How the recovery is going to be made? The recovery is going to be made, firstly, by domestic leisure that we are already assisting. Our tourism this year was basically sustained on domestic leisure. First, after that, the increase in corporate demand. After that, cross-border tourism, and finally, recovery on MICE business. And what are the challenges for the industry? Social distance, limited touch points, cash flow pressures, operating rising costs, and maintain the brand standards. And finally, to conclude my presentation, I would like to remind that the economical science teaches two things. First of all, we have moments of crisis, and we have moments of economical growth. This is one reality. The second one is that every time that we have a crisis, we are going to have, in the growth that is going to appear after, it's going to achieve a higher peak. So this is for sure what we are going to have in a couple of years. We are assisting to a decrease in our activity, but for sure that we are going to achieve a higher stage than when that we are right now. Thank you for your time and attention. Thank you.
Thank you, Paulo. Now up for me to talk about winners and losers. I have to say that when I was thinking about who are the winners, who are the losers, it seems an easy task, but it's not maybe that easy. And ultimately, I got this phrase on the internet, and I think you probably also recognize on it. We try to get it right, but none of us, I think, we get it 100% right as what is going to happen. But let's try to kind of guesstimate what's going to be in the near future. So who are the winners? Definitely, and this was made in agreement with my peers here and my friends, income-generating assets. I think we all agree that investors do seek now in assets that are generating income. Of course, that depends a lot on the tenants you have. So the screening on the tenants that are the generators of that income is now much more in the eyes of investors. Core markets, as opposed to more undeveloped markets, also a winner in this COVID environment. Investors tend to get away from the most riskier places. The regional hubs, we discussed this a bit. Here we are talking about those hubs that can appear next to big cities in commutable locations. So we're going to see some of these hubs being developed in order for those people that live outside of the city center and were taking a lot of time to commute. Those people still don't want to work at all times, like Paul was saying, at home. And they and their employers like to have them in a working and in an office environment. So we're probably going to see some of these regional hubs being developed. Equity buyers, I think that's more or less of a no-brainer in an environment where banks are more reluctant to finance and are paying much more attention to detail on the projects that they are asked to finance, those who have the equity with them will be winners in this crisis. But also distressed real estate funds, so the so-called opportunity buyers. We believe that there is now more space for those buyers in the market compared to the previous market situation where probably there was much more competition. Now, although we believe that we are living in a pretty healthy investment market, and probably we were expecting back in March or April, we were expecting a worse situation that we are currently living in. Although it's a competitive environment, it's maybe slightly less competitive than it was before, so there is more space for these distressed real estate funds. Family offices also, they tend to be more agile, also work with equity. So, and also because real estate tends to be an asset class that these type of investors are now paying more attention. Also there are not a lot of alternatives, as you know, and with interest rates being at 0 or negative levels, family offices will invest more in real estate, and there are more opportunities for them in the current environment. Land buyers. I think this is an interesting one, maybe a good topic for discussion. Because, of course, land and development are associated with more risk. So if there is more risk and people are a bit more nervous, slightly more nervous about development, and it's more difficult to finance, it's likely that land prices will adjust. So land buyers probably a winner in this situation. Sorry. I skipped this one. Well, we talked about logistics. Paulo gave a good description of where we are. And logistics are clearly a winner in this market. I would just add something that I read, and we have Francisco from Blackstone here with us in the room. So I took some notes about a colleague of yours who said that for every 1 billion euro in e-commerce, you need an extra 100,000 square meters of logistics space. So if the numbers are going in the direction that Paulo just mentioned, we're going to need much more logistics space in the near future. Maybe for that, Blackstone owns, I think I'm not wrong, Francisco, to say that you own circa 93 million square meters of logistics space, and you keep buying, and especially on the last mile space. Residential, we see, well, and here we are talking more about the build-to-rent market. I know there's a lot of question marks in Portugal, and we are yet to see how this market is going to develop, but we're going to get there for sure. If you see what happened in the last 50 or 60 years in the US and what happened in Europe in the last 10 years, definitely this is going to arrive in Portugal. We have a lot of developers that are already putting up projects in this space. And certainly at the end of the line, we have investors that perceive this sector as a low-risk, low-return sector that really want to deploy a lot of money into this category. Supermarkets, needless to say, it's a long-income asset. We are all still going to the supermarket. We all talked about in the beginning of COVID that supermarkets were increasing their sales and so on. So it's really a very attractive product. Retail parks, for the obvious reasons. People are not in a closed environment as in a shopping mall. So they can park their car, pick up their goods, and come back home. Healthcare, this was already a trend before. Now it's maybe even more an asset class that investors would like to invest now, because of course we all think that we need more healthcare treatments And those are key, it's a key activity in the future, taking into consideration the current scenario. Data centers also is not so much of a developed market in Portugal. Clearly a huge market in Europe and the US. Of course, with the thousands and millions of data that need to be managed in the future, and with e-commerce growing, and with social media, whatever, the whole data market will need these assets, and these tend to be very stable assets for investors, and they give them a long and stable income, and therefore it's also a very sought-after asset. Agricultural. Maybe here I'm doing a bit of an advertising for CBRE, because as you probably know, we just set up an agribusiness department, and it has been quite an interesting journey. So I've mentioned agricultural here already, having seen in a more close way what type of investors gravitate around this space. They are as professional as every other investor in other asset classes. And again, depending on the crops and so on, I'm not going to go into a lot of detail on this, but yes, it is a very sophisticated and developed sector, and yes, there is a lot of appetite. And in a situation like the one we are living in, agricultural seems to be one of the winners. I have a note here that also says real estate lawyers as winners. I don't know, we have some in the room. But because this is recorded, I thought I wouldn't put that in the screen. And that between brackets I have an agent, well maybe not. We are not that arrogant. Medium-term winners. Well, you know, the border between winners and medium-term winners is somehow not very clear. I have that small phrase up there, we'll have to adapt. Clearly we think, well, offices are not losers, and Paulo clearly showed that offices will still be a very interesting asset class in the future. We see office demand picking up. We see big corporates taking up space currently now in Lisbon. And we saw from maybe late May, June, we saw a lot of that activity picking up again. And we have a lot of prospects for next year. Maybe we are not thrilled about what's going to happen. We are worried, and we are keeping an eye on 2021. But there are still a lot of companies out there looking for office space. We are currently in a typical decline that you see in a normal recession. We're going to see the commutable suburbs being developed, maybe not the smaller cities. And then PBSA, so the purpose-built student accommodation. I think this is clearly a winner. Students want to be on campus or near campus. They are desperate, and I have two of my children, not children, they are young adults, which are in university, and they are desperate to go to London and Macau and whatever. They want to get out of here and want to go to some campus in some foreign country. So definitely we believe that will, certainly if we have a vaccine, the demand will go back to pre-COVID levels. And currently the student accommodation units have been leasing well, and not as bad as one could think about. Hotels. Hotels are perceived as long-term assets, so they will come back as well, same as student accommodations. We all agree that maybe we will need 3 years to go back to 2019 profits. We also think that there is a difference between city hotels and resorts or leisure hotels. I think once pandemic concerns are eased, maybe the resort hotels will pick up more quickly. And on the city hotels, it's probably going to be, we're going to take longer because, of course, critical travel will be replaced by video conferencing in most of its number of travel. We've got senior living and co-working. We had an interesting debate last night about this. Yes, we're going to need senior living. We'll have to adapt. Yes, it's probably not going to be the same type of units that we are used to see in the recent past. We will still going to have to care for the elderly, and so these assets will also come out in the future as needed, and investors will pretty much still consider them for their portfolios. Co-working, like Paulo was saying, I mean, people are kind of desperate to meet again, to interact with other people. Of course, and one of the most interesting results of co-working in the recent past is that people exchange experiences, and especially younger generations, like Carlos was saying this morning. It's maybe not us, but definitely the younger generations really need this interaction to survive almost. The co-working, in my personal opinion, will play an important role in the regional hubs, where probably the office space will be provided by co-working operators rather than a normal office building developed by an office developer. Losers, well, it's a bit tough to put losers here. It's maybe it has a negative charge. But yes, shopping centers, it's pretty much a no-go area for the moment. No surprise for all of us. Yet to be seen what's gonna happen in the future, but of course, shopping centers will have to go into more like a community center where people will meet. So the community purposes of shopping centers will have to be on the top of mind for shopping center owners and managers. We saw hospitals being included in shopping centers or even offices. So the shopping center of the future will definitely be something different, but for an immediate analysis, they are clearly not a winner. Hotel owners and operators, I mean, of course, they are being hit hard by this crisis. It's going to take time for hotels to recover, so whoever owns hotels and whoever operates hotels knows what I'm saying. And by consequence, the landowners, because of what I just said before, are probably going to suffer a little bit during the current environment until we see more confidence coming back to the market and getting back to a more normal situation. And this was it. So thank you very much on behalf of us three for your time.
Well, thank you very much, gentlemen. Yep. It's great to hear that this is so hot off the press that you were preparing it last night. Before we turn the cameras off and go to private debate, just perhaps 3 reflections from me on what you're saying. Logistics, and I'm by no means a logistics expert, but it surprises me still how many people think it's a very simple sector, both operationally and real estate. And I certainly don't believe that. Where you put your logistics, if an operator goes another 10 kilometers down the road, his margins, which are always tight, improve, obsolescence, and I think the whole interaction with the retail sector and the logistics models for click and collect, click and deliver, is going to have to evolve. Who pays? How much do you pay? So I think it's complicated. The shopping centre market, I think there is the big challenge there, particularly in here, perhaps where you can only receive variable rent at the moment, is how do you define variable rent in the lease? What part of the retail journey is accounted for in terms of calculating the variable rent? Is it only where the customer pays, or is it all the other parts of the retail journey that he may carry out in the shopping mall, which aren't tracked? So I think the whole tracking of the retail journey is still a big challenge for everyone. And the office market always amuses me listening to owners and real estate consultants on the office market, which hasn't obviously been as effective because they weren't obliged to close down the offices, is the slight disconnect between the owner and advisor and the occupier. I think the occupier is prioritizing much more sanitary, the health and the good well-being of their staff than probably finance. Perhaps the financial side was much more important. But I think the whole model there still has to work out. Are we going to see big CBD offices, or are we going to see smaller, more localized hubs, meeting places for staff on the days they aren't working at home, whether it's coffee, whether it's training? So I think there's a lot to work through when you drill down in the office market as well. Just 3 reflections, though, personal ones. Thank you very much. Very interesting.